I can explain our strategy in 3 slides. And if you get that, great. If that makes no sense to you, we're probably not a good fit for you. It's probably somebody else. So we take that route up front. Then if we get the first phone call, the first frantic phone call, we'll walk through it again. Okay, here's how this works. It hasn't changed. Regardless of what you heard on CNBC or wherever you were listening, we're doing the same thing. That's how it works. So we let that go. The second frantic call, it's like, okay, stop for a second. I don't think this is a fit for you. And we have fired clients. And we do that not from my context, not from what's good for me and our firm. We do that from what's good for the client. Clearly, this isn't work.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Hello everyone, welcome back to The Path to Wealth. My name is Hannes Henschel, and today we have a very special guest, Brandon Bruckman. Host of the Retiring Real Estate Investor podcast, Brandon runs the Milwaukee office of Insight Investment Advisor, focusing on growing the 1031 and DST business. Brandon also leads the marketing efforts and investment due diligence. Before Insight, Brandon founded West Chapman & Co., a consultancy that assists clients in growing their businesses by gaining insights through data. Brandon has assisted large and small businesses in industries ranging from financial services to logistics to pharmaceuticals. Welcome to the show, Brandon.
Thanks so much for having me on. Appreciate it.
Yeah, of course. So you're big into passive investment and making it accessible for people. What are some of the tools that you work with and Insight is working with, like, for example, the 1031, and how can people benefit from that?
Yeah, there's a huge gap here in awareness, as we've been doing this side of our business for about 5 years for now. And the awareness aspect is there. People, investors, don't think that they can do anything besides 2 options when they're thinking about selling and potentially retiring. They're either going to A, hold their properties forever and die and wait the step-up basis, or they're going to sell and pay the tax. And those are the only options that they know and understand. And they look at the 1031 and go, well, I don't want to buy another building to manage. I'm already doing that. I don't want to do that anymore. Those are my only options. And so we spend a great deal of our time busting that myth up a little bit and saying, well, wait a second. You can actually use a passive asset vehicle in a 1031 exchange as replacement property to get yourself on the beach and defer that tax bill and get to the same place you're trying to get to upon death for your legacy or passing those assets to your heirs. You can still get the stepped up basis and still move those assets onto your family. So you can do that and get passive. And so we spend our time educating folks that this is a possibility and walking them through that process.
Yeah. From a syndication standpoint, 1031s are a little bit more of a hot iron. How do you usually help people understand the process and actually how they get it basically worked out in such a way that it also works for both parties?
Yeah, I'll walk you down what we do for folks and the path we take them down, and then I'll take you down what maybe a traditional GP/LP syndicator would think about when approaching this problem as well. So from my desk, we're looking at and using a vehicle called a Delaware Statutory Trust, which sounds really complicated, but in essence, it is a syndication. It is fractional share interest in real estate. The IRS has recognized that in 2004 as replacement property for a 1031 exchange. So in the eyes of the IRS, you own that property just like you'd own any other building outright. And so it's taxed the same way and has the same treatment. So that's the simple and easiest way for folks to go into and be passive, is to use that vehicle. About $7 billion has gone through that method over the last year or so. So it's a significant size business, still in our eyes, extremely small compared to the much larger bucket of real estate, and the size that we have in this country is tremendously bigger. So it's only a drop in the bucket. Still, many people are utilizing that as an option. So that's number one. From the syndicated perspective, it is very tough. If I'm a syndicator, I do GPLP syndications. A 1031 client comes to my desk and says, hey, I got 1031 money. I want to put it in your deal. The first answer is no, because you can't. It's a partnership. So that's not recognized as actual real estate in the exchange. It's recognized as a partnership. So you can't do that. So what we've watched GPLP syndicators do is carve out a portion of that GP and turn it into what's called a tenant in common agreement. And that is difficult, I think, from a syndicator's perspective. I don't think it's preferred from a syndicator's perspective. In a tenant in common, you are sacrificing control to that investor, at least some control. And in many cases, the debt, if you have debt on that property, becomes recourse to the investor. So a lot of our investors will look at that setup and go, whoa, I'm signing up for the debt too? I don't know if I want to do that. That doesn't sound as passive as I wanted it to be, right? So it becomes a very challenging aspect, I think, for the syndicator that's doing GPLP to go down that path. We have seen people do it and be successful in doing it, but it is more difficult, I'd say, than traditionally raising GPLP funds.
Yeah, and the GPs that I see doing it, they only entertain it if it's like a very significant investor. Like you don't need to approach them for less than $1 million, because there is, as you said, there's other hurdles, and it just complicates the process. And usually the ones that are very strong on raising capital don't like to entertain it.
Yeah, 100% agree. And so from our investor perspective, they're looking at that too and going, well, wait a second, I can do that, which you may love the deal. And I would say if you love that deal, gosh, as an investor, go down that path. However, they look at that and they go, really, I got to invest that full $1 million in one deal. Conversely, I can go to the Delaware Statutory Trust marketplace and invest in 10 different deals. Those are 100K minimums there. And then they're looking at that and they're going, I can chase this sort of golden aspiration of diversification down this path of being in multiple different deals. I can kind of play, we like to say we can kind of play create your own REIT in this sort of setup on the Delaware Statutory Trust side, because you really can. You can really widely diversify yourself if you wanted to. So again, this comes down to, I think, from the investor perspective, it really becomes personal preference and how they think about their holistic portfolio, and the amount of risk that they're taking becomes very important. But you're absolutely right on your point there. Most GPs are only doing this for $1 million checks or higher because of the complexity of doing that alongside the traditional GPLP structure.
Yeah. So how does the DST get structured? And I actually don't know too many people that employ that method at all. Like, it's not being taught as widely. So who usually goes down that route? Who chooses to do this?
Yeah, and I do think it is a fundamental decision that we refer to them as sponsors that put these deals together instead of syndicators. So it's a decision that a sponsor company really takes, and I think it's a 5 to 10 deal minimum that they're making this decision to do. You're signing up for this for a period of time, and it is different from the sponsor's perspective in that the deal is structured in a way in which they can't take the typical promote cut they would take on, say, NOI above a certain level, or giving that threshold and then taking the 70-30 or 80-20 split. Sponsors can't do that in the DST structure. So it is more about an acquisition fee. It's about management fee. It's about disposition fee. So our economics are different in the way that they think about it. And it starts to become a bit more of a volume game, I think, from the sponsor's perspective than it does about chasing that upside inside of a deal. So they have to think about these things differently. The other aspect there too is sponsors are typically purchasing that property before the investors come to the table. They're usually carrying that on, if they're large enough, they're carrying that on their balance sheet, or they're using bridge financing as an intermediary, so to speak, until investors come to the table. The industry works that way so that the 1031 investor coming to that equation doesn't have to worry as much about their timeline, right? So their timeline's their timeline. These investments are waiting for them, right? And so it becomes very easy for you to make quick decisions there and meet those 45 and 180 day timelines inside the 1031 exchange becomes a lot easier. Great for the investor. Not so hot for the sponsor, right? Carrying bridge debt, especially in this environment, very challenging. Using your balance sheet as well, there's an internal cost of capital there that you have to think about too. So this is a big fundamental decision that sponsor companies need to make. In our space, there's about 40 different sponsor companies that do this work, and it's very heavily loaded to that top 5 or 10 or so are easily 80% of the volume that goes through this because they've learned to do this and to do this in succession and to gain economies of scale inside their business to do that. So it's an interesting thing for, I think, for sponsors that are in the GPLP space to think about DST and think about moving to that space because there is a lot of capital there. I do believe it's still very much an untapped marketplace. And I think the economics there have a bit more stability in them than a traditional GPLP deal, again, from the syndicator or sponsor perspective. So it's something that our firm has actually walked a few sponsors through to understand how to do these dynamics and how to make this structure. And it could be an appealing option for folks, for some sponsors as they move forward.
Yep. And just to clarify it for the passive investors, this is called DST Delaware, but at the same time, this structure applies in other states.
It could. We only see this structure operating through Delaware. I believe there's certain laws and tax advantages to running that structure through Delaware. So we don't really see statutory trust set up in this manner in other states. We only see them in Delaware.
Yeah, I mean the setup is in Delaware, but the properties as such can be in other states, right?
Oh yeah, absolutely. The properties are everywhere. I sort of say to investors, like, I know there's this name on this thing that's this Delaware Statutory Trust. Let's ignore the name for a second because that gets confusing. They're like, what's this mean? I don't understand. Leave that to the side, right? It's syndication. Plain and simple. And you're right. It can be any asset type. It can be anywhere. It's mostly Class A multifamily. Most of the properties that you see that are in this structure are designed for the investors coming to it. They want conservative assets. They want cash flow, period. And they want stability. And so that's the asset that you see in this space. You will not see heavy value add. You will not see new construction. Is almost never seen in the space.
Yeah. So it sounds like it's designed for a very, very specific time in somebody's life cycle of their investment. It's like, okay, you're ready to be less hands-on, to roll it over into something that's solid and safe enough that gives you some cash flow, where you can just be like, okay, this is a solid investment that I don't need to care about, and we're good here.
Oh, spot on. Yeah, that's definitely the intention. It's most of our clients have climbed that mountain and they've created a tremendous amount of wealth for themselves. So their objective is, how do I transfer this? How do I think about the next stage of transferring this wealth to my heirs? And what's the most effective way for me to do that? So those are sort of the questions that we're asking. Yeah, I don't think the investment is appropriate for somebody who's looking to grow wealth. I don't think it's appropriate for those folks. I would even look at most of our W-2, we'll call them W-2 clients. We lean them towards GPLP syndications because they have that sort of risk appetite. And they're looking for that sort of upside in some of those deals. So we'll lean them that way. It is definitely not appropriate for all investors. That's absolutely true.
Yeah. So where did your personal financial journey start? Where did you get into the mindset of investing in your own life cycle?
Yeah, reading the Wall Street Journal in high school, front to back, rip through that thing. Same way in college. Honestly, I used to sit in a lot of the finance classes and say, hey, can I just sit in the back and read the paper? Do you guys mind? I just kind of want to do that. Like, yeah, do whatever you want. So I ran when I was in college. I helped run the university endowment fund. So I got pretty deep into public markets, the stock side of things, and I spent 6 years working at a pretty large hedge fund through the financial crisis, and that was eye-opening. And the biggest takeaway from that was we had the biggest financial library that you could imagine in the world. Every finance book of relevance was in this place. And so I read through them all because, frankly, things were slowing down post-crisis for nothing that the fund did. The fund did fine. It's just a function of the marketplace. But I found some books in there that really appealed to me. Systematic type strategies, trend following strategies, momentum strategies. I'm like, oh man, that makes a lot of sense to me. And so I kind of went down that path. So in our business now, half of our side is traditional investing clients. We're registered investment advisors. We employ those strategies in our business now. And so there's about 250 families on that side of our boat that we're managing money for using those strategies. And so that has some sort of bleed over. So that was the start for me. But real estate was never a big part of what I learned about. I must have skipped those classes somewhere in college because no one told me about 1031 exchange or all the tax. Yeah, it's like, well, where was this? This would have been the good stuff. I would have put the Wall Street Journal away and I would have been listening to what was said. And I missed this part. So my business partner introduced me to the 1031 exchange because of experiences he had in his family. So his father owned 9 hotels in the state of Kansas and had this problem many years ago. He's like, hey, look, I need some cash out of these. I got 4 sons. I got to send them to college. We got to work this out. So we took Josh, is my partner's name, took Josh to the CPA and said, hey, I'm going to sell one of these hotels. They're like, cool, you have a 40% tax bill. He was like, what? What are you talking about, a 40% tax bill? I don't understand. So I said, Josh, go fix this. And so that sent him on this path of trying to find different ways that you could do an exchange, you could get some passivity, you could pull some cash out and really solve this problem. And so we spent our time trying to figure this out. So we probably spent 2 years just researching the space and trying to figure this thing out. You know, lo and behold, there is a ton of people that are in the same situation that need this help. So that's sort of the story. I wish someone would have told me about real estate earlier. That would have been helpful. But now I'm all in on my side. I'm all in personally as well. I'm a personal passive investor too, so we definitely eat what we cook.
Yeah, too. And it's really, real estate sounds a bit boring, which is one of the reasons I eventually saw the appeal, because at first I was also investing a little bit more in the public markets. I was investing in startups directly, and eventually I was like, okay, I actually want something more boring, that's more predictable. And that's when I started diving down into real estate. And it is, after all, if you don't over leverage, if you don't become greedy, it's a very, very predictable vehicle to build and also sustain wealth with all of the tax advantages that you and your firm are also applying. It's a tremendous vehicle for families in the United States.
Yeah, it's unbelievable. And the tax aspect of it is the part that I completely miss. So my perspective was probably similar to yours in the public markets. And I was so concerned about liquidity. Liquidity was this huge thing to me. It's like, I need to be able to move in and out of assets, right? And I can't do that in real estate. So I ignored it. But wait a second, like the tax benefits on a year by year basis, this is basically, in essence, tax-free income. Like that really changes the equation in a big way. And that was the piece that I was missing. I'm like, oh, okay. I feel like I'm being compensated for the perceived lack of liquidity, because you can solve that problem too, right? I'm being compensated for that perceived lack of liquidity in some of these return patterns in a really great way. And you're absolutely on point about the stability here if you're keeping the leverage in check, and the leverage is so important. So I got a front row seat to watching how leverage can impact and negatively impact any investment position. I got a front row seat for that. So I have great understanding of the leverage and the risk associated with that, and over leveraging yourself and the problems that I saw with that. So yeah, I mean, real estate. And it's funny you mentioned boring about real estate too, just to comment on that. When I really dug into the most successful investing firms, even in a public markets perspective, their offices were a lot more like a lawyer's or a CPA's office, where it was very, very boring, than they were like a trading floor that I sat on and what you see in the movies and all these people yelling and screaming at each other. The people who are really successful make it really boring. So yeah, I'm with you. I like boring wherever I can find it.
Yeah, I mean, if you look at Charlie Munger, who's like 99 now, and Warren Buffett, those guys are like not frantic, they don't run around like a trader or something. And I think with all that less friction, they have a lot more clarity to play a longer term game with a lot less trading fees, overall a lot less friction, also less tax liabilities. And they just sit and wait and become more and more wealthy as they keep making better and better decisions.
They have a system and they execute a system. It's not our system. We have our own system. But we do the same thing. We just sit and execute it. And once you get to that point where you understand that, yes, this works from a public market perspective, and then you watch the calamity that we have going on in markets now, doesn't even bother us. And it's funny, it doesn't bother our clients either, because they've gotten used to the way that we do things, and they know exactly what we're going to do, and they know exactly when we're going to do it, regardless of the market condition. That feels good. Feels great for me. We don't have to worry about that. I think a lot of other people that sit in our seat spend a lot of time worrying. Don't need to, man. Just need a process and a system, and you got to execute. That's it.
I also think what you said about the clients, there's two kind of ways that I look at it. Like the people that I want to take money from as passive investors, they need to have a certain level of education and understanding of what we're doing, because otherwise they will make all kinds of calls. Is reading the news, the headlines, they're like, is my money safe, and then they also they just need to understand that there's cycles, and certain cycles are different from others, and I think you want to work with people that understand both those things, that have education as well as understand the cyclical nature of investments, and that don't give you those frantic calls, so that you can actually do the better work instead of just putting off personal fires that are being triggered by news channels.
Well, we'll approach this a couple different ways depending on the client. So on the real estate side, I will talk about everything that's bad about 1031 exchange, Delaware Statutory Trust. I'll do all that up front. And if that is not appealing to you, cool, then we can move on, right? So we want to get that all out of the way immediately, because I don't want to force you into something that I can tell you don't want to do. And we're pretty astute at identifying when people want or don't want to do that. So that's the real estate side. On the investing side, I can explain our strategy in 3 slides. And if you get that, great. If that makes no sense to you, we're probably not a good fit for you. It's probably somebody else. So we take that route up front. Then if we get the first phone call, the first frantic phone call, we'll walk through it again. Okay, here's how this works. It hasn't changed. Regardless of what you heard on CNBC or wherever you were listening, we're doing the same thing. That's how it works. So we let that go. The second frantic call, it's like, okay, stop for a second. I don't think this is a fit for you. And we have fired clients. And we do that not from my context, not from what's good for me and our firm. We do that from what's good for the client. Clearly, this isn't work for you if you're not getting it third time. Clearly, it's a bad fit for you. Here's a list of people that you should call that probably are a better fit for you. I'll happily hand that out and move them along. We have the luxury to do that on the investing side of the book. On the real estate side of the book, same for you. You don't have that luxury. Once folks are in, they're in. So more of the screening up front of, are you sure you understand what this is, and can you handle the things that could happen, is really important to do that. For everyone involved, it's important.
And that's the tricky part that I learned in general. Partnerships and investments, whether in LPs coming in there, there's still a certain level of partnership where you're tied up for the entire duration of this business, and that's where you really want to make sure who are you taking your money from, whether it's a large investor with private equity or something, or it's a small investor. It's like you also want to understand, like, hey, are they stretching themselves too far? Are they giving me their last 100 grand, the only 100 grand that they have to invest?
Yeah, 100%. I mean, in the real estate conversation with the 1031 DST type prospect, I'll kind of sneak in, because a lot of real estate people don't want to do this, but I'll sneak in like a financial planning conversation into that questionnaire, into those questions I'm asking folks. Like, understand what we're talking about is very liquid. Like, I can't really get your money out when you ask for it. tell me about your liquidity. And then we'll walk through that. Like, tell me about your needs. And then all of a sudden we're talking about goals. And then I can see the full financial picture. So I kind of like cracked that door open that I think a lot of traditional real estate folks, they don't want to talk to an investment advisor or financial advisor. They don't want to talk to people like me about this stuff, right? They think they have that figured out. So it's good for us to kind of like open that door a little bit and kind of peek around and see, okay, does this make sense or not for you, right? And if there's a liquidity issue in that equation, there's absolutely no reason you can't do a partial 1031 exchange. Take $100K or so off the table, pay the tax on that, have the liquidity available. You can do that. That's okay. And we'll advise that for some people. It's really a weird thing to say, like, yeah, I advise you to pay some tax. Like, who says that from my seat? Yikes. But it makes the most sense for them from a liquidity perspective. So it's critical for us to crack that door open and see what's there so we can help people make a good decision.
Yeah. And, sometimes having cash now is more valuable than having a bit more cash a couple of years down the road. And actually, I think the current market environment, we're seeing that where even institutional players taking money or rather chips off the table because they want to make sure that they're in a position to play rather than having bigger gains in the books but not being able to maybe make better deals right now.
Yeah, I totally agree. Like the era of easy money is over. The Fed has changed the playing board that we operate on. And so the incentive now appears to be short-dated treasury, short-dated, risk-free-esque assets. Use my quote fingers on that. Because you're being incentivized to do that. Like 4 to 5% yields to lock your money up for 12 months. It's not a bad idea in a risk-free type situation. You're being incentivized to do that. That's completely different than before the Fed raised rates, where you're incentivized to buy as much risk asset as possible. It's basically what the Fed is telling you to do, right? So things have changed, and people need to be very cautious. It's time to be very, very cautious about especially the real estate investments that they're making, and understand what kind of cash flow you're buying at this point and what you're paying for it. I see some mismatches of that in the marketplace. It makes us nervous.
You mean where the cap rates are still too compressed for the cash flow that you're actually purchasing at the current interest rates?
1,000% is exactly what I see. And then I see that being supported by, more increased rents over 3 to 5 year period that frankly is just unsustainable. So I'm like, this doesn't add up compared to what you can get from, and this is where I think I made a post about this on LinkedIn a few days ago. And I asked people, what's the safest place to put your money? 50 people responded. 70% of them said investment real estate over banks, over U.S. Treasuries. I'm like, whoa, time out, friends. Like, understand at its simplistic, tiniest, lowest element, real investment real estate is significantly riskier than those other options that I've laid out for you. It just is, right? So I think there is a little bit, there still feels like there's a little bit in the marketplace where people don't really have a good, clean understanding of just what risk is and how risky these assets and these deals that we are talking about. Now, you and I do everything we can to pound the risk out of these deals and to make them as safe as possible, but they're never going to be as safe as the U.S. expecting the U.S. Treasury to pay your money back. They're just not. I just need people to understand that just a little bit, right? I don't think people do.
I mean, the U.S. Treasury doesn't get a whole lot safer. If
it is literally called the risk-free rate. That's what it's called. So if you have the risk-free rate is higher than the cash flow coming off a property, like, you got to really think your way through that. Like, that doesn't make sense. You're not being compensated for the risk you're taking, and so you need to back away from that.
And the interesting thing is that like most countries in the world don't have that luxury, where like the U.S. has that kind of risk-free rate where you can go. In Europe, you don't really have the same mechanism for an individual country. Like Germany by itself cannot just say, "Hey, we're going to make you whole. We're going to print a bit more money here for you."
Yeah, totally different setup when we're talking about how to operate inside of some of those other countries too. Maybe those folks should buy treasuries too and hedge that out. I don't know. It's something to sort of think about as well. But yeah, it's a different equation when we're talking about buying German bonds versus U.S. bonds versus other risk assets, a totally different equation.
But it's one of the luxuries we have in the United States. It's we're in one of the strongest real estate markets in the world, and we have a capital stack there and an incentive structure on the tax side that is, it to some degree exists in other countries, but it's really remarkable, and it really makes a great avenue, great path for any family or individual to create wealth and sustain wealth.
Yeah, it's a beautiful thing to have the world's reserve currency, and then to have an economy that backs that with a tremendous amount of power that's behind that as well. It is definitely a luxury that we experience, and we kind of start to play these games about, okay, I understand the debt situation we're in America, and that debt to GDP ratio is climbing, and that's kind of scary. Who's going to step into that void and be the new reserve currency? When we play that game out, it's really hard for us to find any choice besides America. Plus, this reshoring effort's a real thing, is that we've been digging into that a little bit more. We will make things again here in America, and a lot of stuff, and we have the infrastructure to do it. That is tremendously interesting. So you could see a great revitalization of America over the next 5 to 10 years of a manufacturing superpower. That's crazy to think about. I don't think any country's gone through that kind of life cycle of being here as, we build all our stuff here, now we don't, now we do again. I don't know if any country's gone through that life cycle that way.
Yeah,
it's fascinating.
I think what's very fascinating there is that the U.S. has the technical skills and the capacity to actually do that on their own. Like, whether it's about the manufacturing capability to build the robots. Like, there's companies like Tesla who build world-class robots. Basically, the entire gigafactories, that's like a giant robot in itself. And so the capabilities are there in the country itself, so they can develop it. At the same time, from what I'm understanding, and I mean, by no means an expert in technology development in China, but it seems like they have a lot higher rate of new development as a whole, as a country, which is usually what propels the next leader in the world forward, is making a leap in technology and development. And that's something where I'm a bit concerned in the US. While I do see progress, lasting progress, I feel like there's less incentive to attract the best thinkers in the world right now, and to make a business-friendly environment, at least in some states. And that's where we kind of have to be happy about, places like Texas that still attract companies like Tesla and people that really want to do something, and that not getting too limited. And I don't want to get too political here, but you hear what I'm saying, right?
Yeah, totally. Yeah, and we sort of, we recognize opportunities in, we refer to them as tax progressive states. Our preference is to operate in non-tax progressive states, frankly, in terms of where we're looking at investments. Yep, that's definitely, I agree with you. I think that's definitely a headwind for us. I do think one of the additional advantages we have in America is that we have the needed natural resources are here to do what we need to do. China, I don't think, lives in that same sort of advantaged position. And I'm going to caveat all this too with, I'm not an economist either. So I play economist, on the side a little bit just because I'm curious. But it leads us to the conclusion, like if we can continue to attract that talent to our country, that's another aspect that a lot of countries have never had before. If we look back, if you kind of play that Ray Dalio game of looking back through history, which is very smart to do, the missing piece is that we have immigration here that should, if we do it right, attract the smartest people to come to America. No other country has had that kind of setup in that historical perspective. And frankly, that's probably why some of those empires have failed. Now the dynamic is different, right? So it is extremely important that we're attracting talent to come here, the best and brightest, and we build stuff. Gotta have it.
You know, you're making a really interesting point. Unprecedented overall global situation. And the US has two benefits. One major is that the world learns English in school, whether you're in China or in India. You know, some of the smartest thinkers in the world start learning English very early. And you know, me originally being from Germany, I see one of the major issues rolling in Germany is we're not attracting anybody from anywhere in the world. And we will be like Japan 2.0. Mm-hmm. And like in 15, 20 years from now, I'm wondering who's doing any of the labor that's being needed in Germany, because it's not the Germans that fill those gaps. And they are not attracting people because there's language barriers. And there's also political barriers, whether it's like the entry level to actually enter the country, the kind of qualification you need to have the country. And that's, I think, whereas the US is uniquely positioned to attract from the highest level to also to a lower level for simple labor like farm labor, and there is construction labor that you need to be a thriving economy. There's a lot of service labor you need to be a thriving country. And I think the US is uniquely positioned to attract a lot of them and absorb, if they do it well, some of the best in the world.
Feel the same way too. I'd like to preach this to, I don't want to be political either, but both of our political parties sort of like to tell us how bad things are. I don't think so, man. Like, there's challenges that we have for sure, and there always will be for us to work on. But man, I tell you, when we talk about it in this context and in the broader historical context, America's positioned again like no other country ever has been. It's a great time, man. People got to kind of go out. I want people to be happy, smile on your face. Never been a better time to be alive as a human being in the entire history of the world. I like to remind people of that. Like, we've never lived longer. There's never been less people in the entire world in extreme poverty. Ever. Ever, ever, ever. Right? So let's remind ourselves that even though it feels overwhelming every day with the negative stuff that's just poured on you, when you look at that historical context, we're doing really good. And all indications are we're just going to continue to go along those paths.
I read a quote, I think it was from Barack Obama yesterday. And I can't quote it properly, but it's somewhere along the lines that if you didn't get to choose who you are, and you had to choose a point in time when you were born, you would choose now.
100%. 100%. No question.
Yeah, that's really, you know, there's a beautiful book by Hans Rösling. It's called Factfulness. Now it's a couple of years old, but I think his, there's two people in his family who are actually moving to work for Wellth. He died a couple of years ago. And in the first couple of pages, it asks you like a bunch of questions, like how do you see the world, you know, in terms of poverty and how many, it's like, and when you get through the book, you realize, hey, it's actually, like you said, it's never been this good. And obviously there's still a lot going on. Mm-hmm. But the question is, how much news are we consuming, and how much do we keep cycling through our head of what's actually relevant or not, and what's the fact in it, and what's just news cycle?
Yeah, it's sort of scary to me when here's things that scare me. So things that scare me are the ease at which we're able to be manipulated through the media and the information that we consume. Boy, is it easy. It is easy, and it's hard. It is harder than ever. I will give this to folks, and I feel bad. Because it's very difficult to cycle through even one item in the news and figure out, is this true or not? It's hard. It is not easy. It's hard for me to do it, right? And I'm not a rocket scientist or the smartest person in the world, but nor should I be, to realize if what I'm looking at is true or not. Like, this should be easier to understand. So it's very difficult. So I try to give people a pass on that. There are some resources that folks can use to kind of help them. A great website is called All Sides. I don't know if you're familiar with this. It'll show a news article headline, and it'll show you 3 different news publications across the political spectrum, so you can at least see how a story is being talked about in multiple different ways. Because I think we get too stuck in our echo chamber. We only hear what we want to hear, and the social media is designed that way, so we stay engaged. Stepping outside of that echo chamber is really smart. Go read something from someone that you don't agree with, right? That's okay. You can do that. Consume that information so you can at least understand how other people are thinking about things or even how they're talking about things. It's helpful to kind of get a better, bigger, broader perspective on the way things are. I think people will be happier people if they do that. The downside is that, man, it's really time consuming. I got all day to research all this stuff, right? I got stuff to do. So it becomes very difficult, I think, for people to really disseminate information that way. But that might be a starting point for folks to get a broader perspective.
I like that. And it's, sometimes it's challenging to go over content that you disagree with, where I'm like, hey, wait, what's going on here? It actually might feel uncomfortable to allow yourself to go through it. But I think it makes for a healthy debate. And we all have blind spots. Like, none of us has full perspective on things.
No, it's spot on. And the fact that you have a blind spot's a great place to start. I think some of our friends out there aren't aware of where they may have some blind spots. So a little self-awareness would probably go a long way too. trying to just be a more upbeat and more optimistic about where we are. The self-awareness would be a big adding point to help folks for sure.
Yeah. Brent, talking about self-awareness, one of the questions I like to ask is, what do you consider a life well lived?
Oh, that's interesting. Whew. I think there's some boxes to sort of that you kind of want to check there. And this is a struggle for me too. So we're gonna go on my blind spots a little bit. Health is probably utmost and the number one, because frankly, if we're not healthy, all the stuff we're talking about is inconsequential, right? So it's making sure you're taking care of that. For me, it's family too, and making sure I'm doing everything I can to enable my children, support my wife, support the rest of our family in any way they need. That's very important. And then for me, for a long time, a missing aspect was faith. And so I think you need to believe in something. I have biased opinions on what I believe in, but you got to believe in something and a higher power of some sort. I think is helpful just for self-development and growth. And then after you've done all that, then you can start focusing on the wealth. I do think that comes last. And maintain that wealth. And then for me, it is legacy building. Like, I've looked at the history of our family, and over a long period of time, all the way back to, I have some roots in Germany as well. A lot longer than when you've been there, but a long time ago. And I can see the path of wealth created and then destroyed. Created and then destroyed. I'd like to break that cycle a little bit. The numbers are fascinating. I'm sure you're aware of these. By the third generation, most of that wealth is gone for the vast majority of those families. I'd like to break that cycle a little bit for our family. That would be great. And so maybe that's a life well lived past my timeline. But I'd like to look down from wherever and be like, oh, okay, my great grandkids are doing okay, and I hope to be part of that.
Yeah, I think now maybe more than ever you have the ability to make yourself heard, because you can actually record yourself, which is what you're already doing through your podcast. But I think one of the biggest issues in transferring wealth is actually having the education and the knowledge that accumulated the wealth or that sustained the wealth. And that can easily be squandered over 2-3 generations. That's
a great point. It would be fascinating, like 100 years from now, to look at what will, our great grandkids be watching. Will they be watching this and then learning from that? I don't know. That would be great. They'll have the ability to, hopefully. So that'd be outstanding, right? So yeah, I mean, theoretically, I think you're absolutely onto it. They'll be able to learn from that, and kind of keep things going. I hope, because you're right. There's no way for me to listen to somebody from 200 years ago. I can't.
Yeah, like I have a very long, at least on paper, I have a very long kind of family tree that I can recognize where people were, but I have almost no information about any of these individuals, what they were thinking, what were their conversations like, what were their money habits. None of it is recorded, almost nothing. over hundreds of years. There's, I mean, a couple letters I have from some of them. There is actually very little information because it wasn't recorded. Most people wouldn't sit there and write down their life story. So besides letters that they wrote to each other, it really boils down to that. Yeah, there's nothing there. So we are the first time in history where we have access to cheap recording. Like even the photo, a family photo 100 years ago was expensive, and you would have to stand there for a little bit of time. It's not something you just snap on your phone. You had to call somebody, and it was imprinted on a plate. And the German photos, they look very stiff because they couldn't smile because you had to stand for a bit there. It's like, so it's, you know, the first time in history we were able to actually record ourselves and maybe give it to another generation. Even though maybe 2-3 generations from now they will just speak to their, I don't know, AI hologram, and it will be smarter than you and me combined. It's like,
I hope so. It's funny you mentioned that about your family history. Actually, behind me, for those watching, on my shelf is, you can't really see it, but it's a bounded book that my uncle put together probably 15 years ago, before the DNA testing and all that stuff. He took a decade to go through our family history, traveled back to Germany, back to England. But the only things that are recorded in there are people's names, where they lived, when they were born, when they died, maybe what they did. That's it. You're absolutely right. There's no context of how did you approach life. It's not there. It's a great book. It's awesome. I love that he did it. It helps me gain some perspective about our family. But man, yeah, the context would be really important. I would love to have some of that, and it's just not available. But now it will be. And gosh, it'll be incredibly intriguing to see what future generations do with it.
Yeah. Well, Brandon, this has been super, super interesting. I love the way you think and the insights you have. Where can people connect with you and with Insight?
Yeah, this has been great. Thank you so much for having me on. It's a fun conversation. Couple ways to connect with me. Easiest is to shoot me an email. It's brandon@investwithinsight.com. I'm happy to get on a call and talk to anyone about any of these topics. Website's investwithinsight.com, and then very active on LinkedIn. Just type my name in. I'm easy to find.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.